Well, the biggest healthcare meeting of the year kicks off today in San Francisco. More than 350 companies are expected to make presentations to about 8,000 attendees and investors at the JPMorgan Healthcare Conference. Bloomberg's Shannon Pettypiece is there, and she joins us with venture capitalist Stephen Burrill. He's the founder of Burrill & Company. Shannon, take it away.
Hi, Betty. Well, that's right. This is the biggest meeting for healthcare companies. Hundreds will be making presentations to try and woo investors. One of those investors is Steve Burrill. Steve, tell me, there's a lot of hot technology out there. What are you really focused on? What are some of the areas you're investing in?
Well, one, genomics. We're big investors in genomics, mostly in the context of moving to personalized medicine. Mostly that means new diagnostic technology that can identify disease earlier and move us to a more preventative stage. Secondly, we're very involved in consumer digital health, kind of the spit on your BlackBerry world, where we have a little bit of microfluidics technology in your cell phone, and we're able to, much like the GPS, we're able to diagnose what's going on in you. We're big players in the international scene. We're looking at technologies that can have impact in China and India and Russia and Brazil, places like that. Generally later stage than most people have historically invested in. Early stage capital is tough for us to get the kind of returns that we want. So by and large, product-based companies are companies that are more risk-abated.
Yeah, you mentioned tough raising capital these days. The past few years have been really difficult for some of these early-stage biotechs. Tell me what's been going on, and are we going to see that change in 2011?
Well, interestingly enough, in 2010 and in 2009, two of the toughest years in the financing history of the world, the industry raised more money in each of those 2 years than any other years, raised about $55 billion, both in 2010 and in 2009. Why? Because we had to. Companies raised money at not very attractive terms. There were 17 IPOs last year, 3 the year before. Those IPOs last year, the 2010 group of IPOs, down 33% on average. The buy side that invested in them essentially got hosed. And so capital is available. It's expensive for companies, difficult to get, but we'll see an enormous amount of fundraising in 2011. I think this meeting will kick off a boon in the public equity markets. We'll probably see some 25 IPOs this year, against 17 last year, maybe as many as 30. And we'll see many companies running around the world globally financing in a very different environment.
One of those deals that's been getting all the buzz at this meeting is Sanofi and Genzyme. You think that deal's going to get done? And is that kind of generating some investor interest again in biotech?
First of all, it is getting done. It'll probably get done at around $80 a share. The issue really is how much do the ARBs have of the stock? Genzyme believes that Henry believes he really has control of the company. The question is, do the ARBs really have the majority of it? In fact, it'll probably be announced this week somewhere around $80 a share, and the deal will be done. Will it stimulate investor interest? If you look back over the last 25 years, we've had a few marquee transactions every single year. This will be the marquee transaction for 2011. It does give confidence to investors that even if the IPO markets aren't attractive, there is an attractive exit because Big Pharma is desperate to acquire innovation. And so we'll see an increase in the acquisitions, we'll see an increase in partnering.